A comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about the most interesting new ETFs which made their debut in the first quarter of 2025, which was a terrible quarter for stocks. Thankfully, it's over. So, US stocks posted their worst quarterly performance since 2022 in the first quarter, and gold had its best quarterly performance since the 1980s. But it was a blockbuster quarter for ETF launches. 231 new products were introduced. And with this, at this pace, we are on track for a new blockbuster annual record of launches in 2025. And what is interesting now is most of these new ETFs are actively managed. In fact, 200 of these 231 are, which is more than 85%, they are actively managed. And as I have mentioned many times in the past, that for newer providers and newer products, for them it is not possible to compete with the established players in the space. So they try to do something new, something innovative. And lately we have seen that most of these ETFs are using derivatives. So two recent rule changes, the ETF rule, which made it easier to launch ETFs, and another rule which made it easier to use derivatives in ETFs. Because of that, so many of these new ETFs use derivatives. And following the blockbuster success of NVIDIA leveraged ETF, NVDL, which had gathered more than 5 billion in assets, many providers are launching leveraged single stock ETFs. So you can find leveraged single stock ETFs virtually on any stock now that you can think of, any volatile hot stock, and you will find a leveraged single stock ETF for that particular stock. But investors should remember that they are meant only for short-term trading purpose. Then, following the success of JP Morgan Equity Premium ETF, which did quite well in 2022, there has been a surge in launches of covered call strategies for high income generation. And lately, because of the market volatility, we have also seen a surge in defined outcome or buffer ETF launches, which cap your upside but also cushion your downside. So we are highlighting 4 new ETFs that are quite interesting because of their unique strategies or exposure. And I'm not talking about their performance potential that we will see in the coming months and years. So the first one which I'm highlighting is by State Street Investment Grade Public and Private Credit ETF. Ticker symbol is PRIV. This got a lot of media attention, and the fund launched, and after that the SEC indicated they were not too happy about the fund and they wanted certain changes and Apollo's name removed, which was done. But in general, we have seen this rush to bring private assets to retail investors, and we will see more of ETFs like this one in the coming months. So private assets are both debt and equity investments in privately owned companies. They have seen rapid growth in recent years. And so far, institutional investors and ultra net worth individuals, they had access to these assets. And now through ETFs, retail investors will also be able to get access to these private assets. So the SEC places a 15% limit on open-ended funds, both mutual funds and ETFs, for illiquid investments. And an investment is classified as illiquid if it can be cannot be sold within 7 days without significantly impacting its market value. Now, this particular ETF can, according to its filing, this can hold up to 35% private of its portfolio in private credit. And the unique thing about this ETF is they are able to increase this exposure beyond 15% because Apollo acts as a liquidity provider, has an expense ratio of 70 basis points. Let's go to the quote page on Zacks.com. Using the link, you can go to State Street webpage for this ETF. You can learn more about this ETF. I had also written about this ETF when it launched. So, despite a lot of media attention, the investor response, has been kind of lukewarm. 55 million in assets so far, but it's still too early. And as the name suggests, it invests in a wide range of investment grade debt securities, and the aim is to maximize risk-adjusted returns alongside current income. So, basic objective of using private credit is to get a higher level of income for the same credit quality as public credit. So you can learn more about this ETF. State Street has some excellent documents. So if you're interested, you can read about those. So it defines what kind of public debt and private debt securities it will be using in the portfolio. And the aim will be to get broader diversification, enhanced income. The second ETF, which I'm highlighting, is also by State Street. And this they launched in partnership with Bridgewater. This follows this is the all-weather ETF. ALLW is the ticker symbol. So this will follow the risk parity strategy, which was pioneered by Ray Dalio, Bridgewater's founder. And risk parity portfolios, they invest across a wide range of asset classes, but they do not use the traditional asset allocation like 60-40. They adjust their allocation to asset classes based on their volatility. The strategy will often use leverage, and it rebalances according to market condition. This has an expense ratio of 85 basis points, and compared to PRIV, this was non-controversial, and it has been able to gather more than 100 billion in assets so far, which is pretty impressive because it's a fairly new ETF. So again, State Street has some nice research and documents. So if you're interested in the ETF, because if you expect market volatility to continue, then probably you can take a look at the ETF, and this document describes the strategy and what kind of assets it will be investing in, why it is using leverage, how it will be rebalanced, etc. The third one that I'm highlighting is by iShares. Now, since all these asset manager giants, they are making a big push into private and alternative assets. So I decided to highlight this particular ETF by iShares. This is the first managed future ETF by iShares. The ticker symbol is ISMF. So managed futures, these are hedge fund like strategies, and earlier they were obviously available only to hedge fund investors, and they were also available in mutual fund forms, which were not very effective and very pricey too. So managed futures ETFs offer those hedge fund like strategies to individual investors in a low cost and liquid wrapper. And basically, these are trend following strategies. They tend to replicate the traits of market trend following quant funds also known as CTAs, obviously actively managed, and it has an expense ratio of 80 basis points. So in 2022, when stocks and bonds both had a terrible performance, at that time, managed futures ETFs had done quite well. And DBMF, which is the largest product, the most popular product in the space with over $1 billion in assets, that was up more than 30% in 2022. And that is why managed futures became quite popular. And this just launched so far 17 million in assets, but again, it's too early. And let's see what it is investing in currently. So it is currently this exposure about 17% in fixed income, 14% in equity, and a lot of exposure to cash. And like Straight Street, BlackRock also has some good research. So if you're interested in managed futures, and the main aim of using managed futures strategies is to get diversification. These strategies have very low or zero correlation to stocks and bonds. So as I mentioned, these in 2022, managed future strategies had done quite well when both stocks and bonds were down a lot. In other periods, also, as this document has highlighted, whenever equities had a terrible performance, managed futures were able to do quite well. And they have near zero average correlation to equities over time. Now, the fourth ETF, which I'm highlighting, is rather simple compared to the three other that I highlighted, but it is the first ever US listed ETF which provides exposure to Iceland. So if you're a fan of Iceland or glaciers, take a look at this ETF, Glaciers Iceland ETF. Ticker symbol is Glacier, and according to the provider, Iceland is a leader in renewable energy and sustainable fishing. And because of its political and economic stability, it is worth a look. A bit pricey for passive ETF, 95 basis points, but unique exposure. So again, if you want to learn more about this ETF, you can go to Teucrium, the provider's website, and look at the holdings and other details. Most of us will not be very much familiar with these holdings. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer. Make sure to subscribe to our YouTube video channel so that you do not miss anything. And I will see you next week.